Good evening, everyone. Hope you're all doing well. I'm going to jump right into Chapter 6. And we've got 3 chapters this week. So what I'm going to do, for your time's sake, and to make sure we get through the crucial pieces of information I think you'll need to be successful, I'm going to mainly focus on the slides that have formulas or calculations that you'll need a little bit of help with. Majority of the slides with just text on it and information that you can read. I'm going to leave that up to you guys. So be sure that you're going through the full PowerPoint for each chapter and reading that carefully along with the text to make sure you're prepared for the assignments each week, and then this week we have the test, so make sure you're doing that. But I'm going to focus on some specific things that I think could be useful for you. So we're looking at risk and return in Chapter 6. So let's start out real quick. What are investment returns? Investment returns measure the financial results of an investment. They can be historical or prospective, anticipated. Right? They can be expressed in dollars or percentages. Pretty simple stuff, but we want to know if our investment is getting a return. So in simple terms, a dollar return, how much do we receive? How much do we invest? Right? Our return is $60 or 6%. Pretty simple stuff there. We look at what are some different scenarios for a 10-year T-bond over the next year. We see the probability or the likelihood of these different scenarios coming to fruition. So I want to show you that because you'll see that later on in the chapter. So what does that probability look like in a chart? We can see 6% as the median right there in the middle, and then we've got the different probabilities on the sides. Same thing on a bell curve, and you're going to see that later on as well. All right. So we're going to calculate the expected rate of return for a bond for next year. Okay. Again, as you've probably figured out, there's an easier way to do this in Excel. We can see this fancy calculation, and we're just going to skip that, and I'm going to show you how to do it in Excel. So we're trying, and again, in the PowerPoint, it gives you detailed instructions, which is great. So you should be able to go through and do this very quickly. So we are looking at finding the expected rate of return on a bond for next year. So I'm going to bring Excel in here. Up here we've got our data set. And we say, hey, what do we think of our expected value, or our rate of return that we expect on this for next year? Obviously, you see the answer already, but I did a equal sum product. I selected the probabilities, and then I selected the return. Simply hit enter. So getting the data set up, similar to what we did in the last chapter, is very important. So pretty simple, not very hard. So let me walk through the steps again. It's equal sum product. We want to select the probabilities first, comma. Select the return percentage, and there we go, 0.06, excuse me. All right, so there's the first calculation we're looking at. All right, so this shows us 2 different investments and the probability of how their outcomes are going to go over the year. Which one's riskier? Why is it riskier? So it's definitely something we could come up with some conclusions. But I think we would be better off by doing some calculations. So the next calculation we want to talk about is standard deviation. And that's going to be just the standalone risk of an asset or an investment by itself. Or a single asset, right? So if you think about one asset or one investment, you're thinking about standard deviation. Thinking about 2, you're going to think about a variance, right? So I would highly recommend making sort of a chart or some notes of all these little signs and signals because you'll use them later because they're signals. But it's an easy way to see it if you have it in a chart, or you're going to be like, oh, is that variance, or is that standard deviation? Is it something else? So just create a key for yourself. I think would be really helpful. All right. Most likely we're not going to be using these formulas. All right, we're going to be using Excel again to calculate variance and standard deviation. They give you great instructions for that as well. Again, here is some examples of the functions that we're going to use. There's also the average function. That's pretty simple if you need to find out the average rate of return over a certain period of time. Here's the data set we're going to be working with. And I just simply copy and pasted this into our Excel sheet. And we're going to come up with our calculations. So let me pull that back up. And what we were looking for is, first off, we want to know the variance. So what is our variance between two different pieces or two different investments? So I just created a dummy scenario down here, which is just a second example. We've got the same probability. As you're going to see, that's the same at the top and the bottom. But the chances of the returns being higher and lower are different based on that investment. And I said, hey, what's the actual variance between these two? So to get that, it's a simple sum of the product. You grab the probability, then you grab the return on the first scenario and the return on the second scenario, and it's going to give you that variance. So it's a 0.01 variance, or 1% variance between the two. So again, I'll show you that. Excuse me, sum of the product. Grab the probability. Then I'm going to grab my first set of returns. And I'm going to grab my second set of returns. Close the quotation. I'm going to get my answer and see it's a little farther. Very good. Alright, so the next thing we talked about was average. So here we grabbed in our new set of data. Let's scoot over so we get that out of our way. So that was on the slide you saw there. We got 10 years worth of data. Got the market data. Got Blandy and Gormage. These are two companies we're going to be talking about as we go through the chapter. And we say, okay, I want to know what the average is for the market. Simple, right? Average, I'm going to grab all these numbers. Standard deviation. So depending on what version of Excel you're in, it's going to have some different options. But in the version I'm using, I used standard deviation.s, so that's for a data set. And I just simply grabbed all the numbers and it told me the standard deviation. Pretty simple. On correlation coefficient, I'm going to do correlation, and then I'm going to grab two different data sets. So I wanted to know the correlation between Blandy and Gormage, and we're actually going to get that later, so I'll come back to that one. Okay. So average, standard deviation, those are very simple, and then we also did variance. One quick trick I want to show you, and this is more of an Excel trick, but since our data is laid out, market, Blandy, Gormage, probably not pronounce it, Gormage, I'm going to pronounce that wrong. I laid out my data over here in the same manner, so I could simply just grab these and drag it. And it's going to go ahead and give me the answers because it's just pulling that over. So for Blandy, I can see now I just moved it over a cell. Same thing for standard deviation. I don't have to do it again. So grab and drag is a good trick. Okay. All right, let's get back to the PowerPoint. All right, so using those very simple Excel calculations versus all those other long formulas, we're able to generate this data here. Right? And then we could quickly see, okay, the average return for the market is 8%. For these two investments, I can see what their average return is. I can see what the standard deviation is for each as well. So the average return for Gormage is probably a little higher, but the risk is a little bit greater with the higher standard deviation. Alright, so I jumped ahead a little bit on the Excel sheet, but correlation coefficient is going to be the next thing we're going to look at. And this is going to be the likelihood that two investments are going to move together. This is very important because if you're investing in companies in a similar market or a similar industry, you might be putting all your eggs into one basket even though it's two different companies. So you want to know how likely it is that they're going to move together. So again, we've got a great page here. It's going to show us how to do that, and I'll come over here in Excel as well. So correlation coefficient, we've got a function in Excel called correl, and you simply just use that function and grab your two different sets of data, and it's going to say how greatly they are correlated. All right, there's that. And then you would just compare that to, other industry correlations. And that should be published information you can see when you're doing your research. But that's what I would suggest on that. All right, so market risk is going to be the next section we're going to discuss. We're going to talk about it from an individual stock, from a portfolio perspective. But one thing you're going to see throughout the next couple of pages is CAPM, or Capital Asset Pricing Model. This is what was developed to answer this question. All right, so some quick definitions. So the W with the lowercase I, that's going to be the weight of a specific investment in a portfolio. You've also got your standard deviation of the market index, and then your correlation between the stock and the market is using this symbol here. So, like I said, I would create a key, because as I'm going through, I have to remind myself, oh, what does that mean? Because it's hard to memorize everything as you're going through each of these chapters. All right, so the contribution of a stock to the standard deviation, as well as a diversified portfolio, is defined there below. You can see that. The beta is also defined with this formula. 90% of the time, especially if it's a publicly traded company, you're always going to be able to find a beta. You don't have to calculate it, but for the course, you'll have to do some beta calculations, and I'll show you how to do that later. Contribution of a stock to the standard deviation, and as well as a diversified portfolio, showing you here. So you got the weight of the investment, your standard deviation of the market, and the beta. Right? Multiply those, it's going to give you that. So given the standard deviation of the market and the percent portfolio invested, the beta will measure the impact of a stock on standard deviation of a portfolio. All right, so beta is very important in your calculations, just so we're clear on that. All right, so required rate of return. That's a big thing. So investors require, for a specific amount of time for any investment, some return. And that's called the risk-free rate. Nothing considered, if I invest for a year, I expect this specific rate. And then with different investments, they have a different level of risk, and that's what's going to be your return for risk. So those are two different things we're going to be talking about here. All right, your required return for the market, your market risk premium. I'm going to show you how to do that. So we've got the risk for the market minus the risk-free rate. That gives you the risk premium for the market. And your risk premium for the stock is going to be simply the beta times the risk premium for the market. So pretty simple. All right, so if we want to talk about what is the correlation between a specific investment and the market, real simple, we've got our correlation that we can use. So I've already done that here. So again, I said, hey, what's the risk between Blandy and the market? Right, it's 0.481. So there's a big variance, I would say. If we said the correlation between Blandy and Gormage was 0.11, if I look at Blandy versus the market, it's quite a bit riskier, for sure. All right, let's go back to the PowerPoint. All right, how do you calculate a beta if you don't already have it? We can see that here. We've got our standard deviation. This is all calculations that we've already done in previous slides. That would be the one thing I would say. So right here we've got our correlation, all right, with the investment in the market. And we're going to see that right here. And then we've got our standard deviation for the investment, and then our standard deviation for the market. And multiply that, and that comes up to 0.60. So the average beta is 1.0. So this stock contributes less risk than the average stock. Right? So while there is a variance between it and the market, it is less risky than the average stock. So not a bad one to go after in this case. And we'll finish up on the next video, Mark chapter 6.